One of our regular callers out of Nova Scotia is David in Truro. Hi, David.
Hi. Thanks again for taking my call, guys.
Sure.
David, my question is, I got stopped out of pretty well all my pipelines and got out at some higher levels, and some almost it's back. They inched their way back a little bit to where I got stopped at. And I don't want to jump in and then, like, 2 days doesn't make a market with a rally in the oil. What's your opinion, and which ones would you suggest, and do you hold them?
Okay.
Thanks very much. Bye for now.
So I think this is a great question, because this has been a group a lot of people have made money in over the last 5 years. And it certainly was a big weight in our income portfolios over the last 5 years. And, at the end of the day, as we've said before, we're never going to be able to protect against short-term pullbacks. You want to protect against change in direction. If you look at the energy space as a whole, from one end of the spectrum with the highest correlation to the price of oil, you've got the producers, and you've got the drillers and the equipment companies. As you work your way through, the integrated companies, less correlated, the refiners, less correlated, and the pipelines, the least correlated. Having said that, when sentiment changes in a group, whether or not it's going to impact the fundamental earning power of a company right away or not, the multiple of the earnings that investors are prepared to pay can contract as people lose a little bit of confidence. And we think that that's likely the case in the pipelines right now. Most of these pipes have long life contracts with the purchasers on one end of the pipe and the suppliers on the other, with take or pay contracts that mean they are going to generate the revenue that they generate. That being said, if energy prices stayed low here for 18 months, it's possible you could see the volume growth disappear and actually some production be reduced. So we use stops for the reason that you can make a case fundamentally why something shouldn't go down, but if it does, you're wrong. And so we've been stopped out of a lot of our weight. We I think have gone from about a 23% weight in our income portfolio in the summer of last year. I think we have about a 7% weight today. And some a little better, some a little worse. Like, we think IPL probably is one of the more resilient ones. But just recognize, I'm not sure, to your point, that 2 days of a bounce makes a market. I think that you're likely to see some selling pressure come off these things and for them to rally. But unless they were able to, for instance, on an IPL, it's trading at around $30, unless you saw it trade through $35, $36, breaking out to the upside, I'm not sure we would be putting on any new positions. As I say, when leadership changes, it changes sometimes for a while.
Let's talk to Sonia next, who's in North Battleford, Saskatchewan. Hi, Sonia.
Hi. Yes, I'd like to hear the take on OTC, open text.
Okay. So now here's a question about a sector that really is in favor. Technology as a whole is doing well because corporations are making lots of money. They've got lots of cash sitting in the banks. Corporate cash last quarter hit new all-time highs as a percentage of assets. And there's not a lot of companies that need a bunch of extra capacity because revenue growth is not so strong in a lot of industries. The one thing that everybody does need is productivity. And so if you believe that corporations are becoming slowly more confident, they're likely to invest in their businesses, and the most logical place is in technology, where they can get productivity gains and profitability gains. OpenText is a company that's benefiting from that. They do, content management software. So this is a company that we like. They've had a nice pickup in revenues, nice pickup in earnings. The sector is doing well. It's trading very close to a new high. This is a stock that we own, one of several software companies, and we think it is in the right neighborhood for the next year as corporations, just be prepared to spend a little bit more money trying to build some productivity.
Here's Smita, who's in Woodbridge, Ontario. Hi there.
Hello. Hi, David. I have a question about Lululemon. It had a poor earning, but stock moved up, and they upgraded stock too. So, what do you watch until the next earnings, or is there anything else I have to?
Okay. So again, let's take it from the top. U.S. market is doing quite well. A lot of Lulu stores, obviously, in the U.S. The retail sector in the last 3 months, one of the best performing sectors in the market. you could take a look at the retail ETF, which is RTH, hitting a new high today. It's one that we own in our ETF portfolio. And when I go through our list of holdings, I have a line item for each sector and the number of symbols in each sector. Of all of our sector exposures, we have the most exposure to retail just by the number of names we're invested in. And there's have and have-nots in the sector. Lulu is going through, a little bit of a rebirth and restructuring. Stocks turned higher nicely. They beat the most recent quarter. I think that if you like the retail sector, stock is performing the way that it should be, given a positive thesis. I think you can buy the stock here with a tailwind. I think there's lots of other names in the retail space you want to take a look at also. But this one, I think you do quite well.
All right, a short break as we look at Lulu over 10 years. It has been recovering lately after much higher highs several months ago. More questions from you after this for David Burrows.